Good afternoon, everyone. Welcome. Today, we will be talking about make or buy decisions from an accounting perspective, and we will be learning about Boeing and what they did and what we can learn from their mistakes. Let me start with a question. What happens when a make or buy decision looks perfect on paper, but turns out to be a disaster in real life? That's exactly what happened when Boeing, one of the world's largest aircraft companies, tried to save on costs by outsourcing parts of one of its most advanced airplane at the time, the 787 Dreamliner. They thought they were saving billions. Instead, what happened is that they lost control, delayed the plane by years, and spent more than 25 billion fixing the problems they thought they had outsourced away. This isn't an engineering story, it is an accounting story about how decisions that look profitable on a spreadsheet can lead to financial chaos when you ignore the full cost picture. So let's go back to the early 2000s. Airbus, one of Boeing's competitors, was winning the airplane race. Airlines at the time wanted jets that used less fuel because oil prices were very high. And inside Boeing, the pressure was very intense. Competitors were taking orders, airline customers wanted lower fuel costs, and investors wanted better financial performance. So, someone at Boeing asked a bold question. What if we stop building planes the way we always have? In other words, instead of building everything in-house, what if other companies build most of the airplane for us? Traditionally, Boeing built most of the parts of the plane itself. They control the process from start to finish. But this Dreamliner 787 changed everything. Boeing decided to outsource about 70% of the airplane, including some of the most complex parts like the wings and the main body sections. And instead of paying for factories, tools, equipment, so on, Boeing told these new suppliers, you design it, you build it, you pay for the equipment and research. We'll pay you later once the planes sell. These suppliers were called risk-sharing partners by Boeing, and it sounded brilliant. From a management accounting perspective, the plan looked incredible. It yielded lower direct costs. So fewer Boeing employees meant less payroll, lower benefits and pension costs, reduced factory overhead. It also yielded lower fixed costs. So suppliers paid for their own buildings, tools, and research. Boeing avoided large capital expenses, and this improved short-term cash flow. This meant that the profit per plane on paper seemed much higher. The formula for them was pretty simple. Lower fixed costs plus lower labor equals higher profit. But as we'll see, not all costs show up neat in an Excel cell. So here's what happened. Suppliers in Japan, Italy, and the US would build the parts at the same time. Boeing would ship the giant pieces by plane to its main factory in Everett, Washington. And then, like snapping Lego bricks together, the final assembly would take as little as 3 days. 3 days for an entire plane. But there was one problem. Building an airplane isn't like building Lego, especially when different people make the pieces with different designs, different measurements, and different tools. Boeing worried about costs, but didn't spend enough time worrying about coordination. And that turned out to be the costliest mistake of all. When Boeing started receiving parts from suppliers, they quickly realized something was wrong. The pieces didn't fit together perfectly. Some sections arrived incomplete. Wiring systems didn't match, and important parts were missing. In some cases, engineers opened the finished parts and found temporary fixes or even missing bolts. So instead of assembling this plane, Boeing had to unpack, inspect, and redo much of the work. And the final assembly, which was supposed to take 3 days by their estimates, was now taking months. What had looked like outsourcing manufacturing had really became outsourcing trouble. So let's talk about the costs that no one included in the planning spreadsheet. Those were real costs, but they weren't modeled as relevant during the make or buy analysis. And that is key for us. What is relevant? The engineers flying around the world to fix supplier problems, the rework and design costs, delay penalties from airlines, idle labor at Boeing's final assembly line, and lost time on innovation because remember, those engineers were now fixing instead of creating. Those are what we called relevant costs. They do not show up as part of the cost per unit, but they can destroy profitability. Those unplanned costs piled up, and that Dreamliner program ended up 25 billion over budget and 3 years late. And then something ironic happened. Boeing had to start buying back some of its suppliers it had outsourced the work to just to fix the problems. So think about that for a second. Boeing paid suppliers to take over the work and then paid again to buy them back. This is the ultimate warning for make or buy decisions. If you have to buy back what you outsourced, did you really save anything? In accounting language, Boeing confused savings on direct costs with saving on total costs. And saving on labor doesn't matter when you lose billions on coordination, reputation, and delay. And there's more. When the Dreamliner finally launched 3 years late, it faced technical issues, most famously the battery fires that grounded the aircrafts for months. Now, not all of these problems came from outsourcing, but the damage to Boeing's reputation was massive. And here's the hard truth. There's no general ledger account for loss of trust. And it costs you in customer confidence, in lower sales, in your stock price. From a management accounting viewpoint, Boeing ignored intangible costs. And when reputation drops, future cash flows drop too. You can't depreciate reputation like a machine, but it might be your most valuable asset. So, what are the lessons for accountants and future decision makers like yourselves? The first one, know the difference between direct cost savings and total cost savings. Reducing labor or assets means nothing if your total costs rise due to coordination, rework, and delays. Lesson number two, don't ignore relevant costs that are hard to measure. Travel, communication, integration, and rework are all real and material. Third lesson, never outsource your core competency. Boeing's strength was its engineering coordination, and they outsourced that too, and they paid the price. And finally, think long term. Boeing spreadsheets at the time showed quick financial wins, but short-term return improvements turned into long-term delays and financial losses. So let's turn this into a discussion. If you were Boeing's management accountant in 2003 and someone said, outsourcing will save 5 million per plane, but there's a 10% chance the project could go 20 billion over budget. Would you still do it? How could you design a cost model that includes those risks? What tools or costing methods would give you a truer picture? At the end of the day, Boeing's numbers weren't wrong. They were incomplete. They modeled known costs, not potential risks. They measured production, not coordination. And they optimized short-term reports, not long-term value. As accountants, you are not just number crunchers. You are the reality check between vision and viability. Because sometimes a project isn't too cheap to build, but it's too cheap to be true. Well, thank you everyone for attending the micro lesson. These types of discussions are what we are trying to teach you in our management accounting courses as part of the certificate in accounting at Ashton College. And I hope you enjoyed the micro lesson. Thank you.